Hi guys, I'm Michael here. In this video I will talk about again the Bollinger Bands and we will discuss a little bit more detail, go further with the topic and talk about additional strategies, additional ways you can utilize Bollinger Bands in trading. I need to be honest with you at the beginning of the video that I am not a big fan of the Bollinger Bands themselves. But hey, it doesn't mean that I wasn't trying them previously. But of course, they are just other ways for me that to trade for me that I more prefer than this. But there are also many people that like the Bollinger Bands, so I think it is a good thing to talk about that also on this channel. So yeah, you could decide by yourself whether you like it or not. I would not go down into detail because we all know how the Bollinger Bands look like, how they all work, that the basically, of course, we need to go to the indicators, add them on our chart, Bollinger Bands right here. And basically what they are, the first line in the middle, it's a 20 period moving average, which basically shows the average price from the analyzed from the 20 periods, from the last 20 candles. And those two blue lines are called standard deviations lines. So basically, you know, also from the previous video that I talked about other indicator, that the standard deviation about the view up, that the standard deviations, the standard deviation lies just as this calculation, how far from this moving average the price could potentially deviate. That's the simplest way I can explain it, to not make it too complicated. Yeah, there are a couple ways to utilize those Bollinger Bands, but the first thing that you need to know, and you need to put in your head, that even the Bollinger himself, the author, the creator of this indicator, stated that they shouldn't be used solely by themselves to trade. They doesn't produce any signals, and any sort of indication that they give, they shouldn't be treated as signals. So maybe let's talk about those standard deviations lines, because if we go to the settings, we click for this gearbox. This is a trading view platform. You can have it also on the LiteFinance platform as well. You need to just log in to your client's cabinet and click on the asset you choose to trade. So basically we go to the inputs and we have the length, which is the amount of candles that are being analyzed by this moving average, this orange one. And the standard deviation settings is basically the multiplier of this, we can say, calculation of the deviation. So basically, if we the more we add the multiplier, basically the wider the standard deviations lines goes. So that brings me to this statement that there was some studies, the calculation that into standard deviation 1, 68% of the time the price falls, is bouncing between those lines. 68% of the time. When we go to the setting 2, the multiplier 2, it states that 95 falls into the price is moving between those lines 95% of the time. And we go to the multiplier 3, it is stated that more than 99% of the time price falls into we say moves between those two lines. So, but if we make a real test, it doesn't look that good. So for example, that's not my study. I checked that on other person's blog. I need to find it and send you a link. I will try to find it and leave you at least in the pinned comment. into to this link to the blog of this person that made this study on 5,000 bars, which is 5,000 candles, right? And this person stated that this analysis is more or less the same if we analyze the currency pairs, crypto assets, and even stocks. The number is more or less the same, and the number is for the standard deviation one. The score is around 45%, 44 point something, right? So we can say that for us to have some kind of edge by using this, it's not a good number, right? So that brings us to to this suggestion that if we are using Bollinger Bands, we should use at least 2, the multiplier factor, this one, at least 2 or 3, right? So let's go further down with the topic what we talked about. I have also notes here, so I would not skip anything. Okay, so let's talk about the first method that is very broadly used and is suggested to use, the squeeze method. So if you are some time in the market, you read some analysis, so you know that the market is moving from periods of low volatility to the periods of high volatility, right? So there are moments like, maybe let's mark them with the rectangle. Give me a second, brush rectangle. So moments like this, when the market is, we can say, ranging, when the lines are more or less moves in a tight range, to the periods when the market is moving with a higher volatility, right? The lines are more, the range between those two lines is wider. So the thing is, when we see situation like this, when the lines starts to go parallel to each other and the range is starting to getting very tight, thus suggesting us that the period of low volatility started and we need to wait for the moment of higher volatility to occur. And this is when we see situation like here, when the two lines start to broaden, and the more vertical this move is, they need to both need to go in opposite direction, and the more vertical this move is, the more stronger this move will be, and thus suggesting us that the period of higher volatility starts, and therefore you need to search maybe for an entry moment, and of course to do that you need to use additional confirmation. The Bollinger himself stated that at best you should use 2 or 3 other indicators along with the Bollinger Bands, but the indicators that are not correlated with the Bollinger Bands, so basically that are not that are not using moving averages, and they have different calculation inside, right? So that's the first thing. The first usage is this short method, this squeeze method, we can say. So the thing is also when the price is starting to ranging, for example, like we have it here, there was a period of higher volatility and the bands started to getting tighter and tighter, and in those periods you could utilize the scalping strategies, right? So basically, let me get this more bigger so you could visible it better. So basically in those moments you can just scalp when the price bounces from one band to another, right? So we are talking about these moments, right? When the price is bouncing up and down from the bands, it is a good moment for scalping strategies, or just use bands by themselves. to determine the entry and exit levels, right? So this is the another usage of the Bollinger Bands. And the next thing that I want to talk about, let's remove drawings, is that when the price goes beyond the standard deviation lines, so if it goes above or below the standard deviation lines, it suggests that the market is at the moment oversold or overbought, and there is a possibility that the opposite move will occur, right? So when the price goes beyond, that's suggesting us that it might be a sell opportunity, again, as it is here. And if it goes beyond to the downside, it suggests to us that the possible buy opportunity is coming, right? So that's the another usage of the Bollinger Bands. And right now let's talk about one additional strategy for this video that I wanted to show you, but I saw many videos about this strategy, and it was hard to find for me the good usage with the settings that I saw in those videos. I watched various ones, but I wanted to make it as useful, as much easy to implement and to work with as possible. And so because many of them many of the ingredients of the strategies combined with the Bollinger Bands and RSI contained, for example, some price action moves, etc., which are arbitrary. You can, they are not specific. You can basically all candles interpret however you want, so that would be not a good indication for you to enter the market, especially if you are a beginner. You need to have clear rules as to when enter the market. So let's add this RSI indicator. The RSI indicator is the relative strength index. Basically, we talked about this indicator many times. It shows the momentum that occurs that is on the market. And for example, this line shows you how strong this momentum is, and it suggests those levels, the 70 and 30 levels, suggests that when the price is the RSI line is above 70 level, suggesting that the market is currently overbought, and when the line is below when it is below, it is suggesting that the market is oversold. So the thing is that we need to do first change the default settings, because default settings are 14, which means basically it analyzes last 14 candles. But in order for us to have good entry signals and to have sufficient amount of those signals, we need to change it to 10. Source close, which means analyze on the candle closes levels. And so basically it is a scalping strategy. So at best you should use it on a 30 minutes time frame. And if, for example, I think it will not matter if you will watch for the periods of when the market is trending to the upside or to the downside. You could check both sides of signals, so it doesn't matter if the market is going to the downside and you will try to take a long position, because it is a scalping. In those trades you will be taking only around 15 to 20 pips, so you will not try to catch a trend, rather to scalp it. Of course, I need to tell you, of course, that if you will get the experience, you will be able to filter out some bad entries when you see that the clearly it is an uptrend and the price don't want to go down in order for you to enter the long trade, or in order for you to, you know, get profit from the sell trade, because the movement is very strong, that the price will not come down and reach your take profit. You will be able with the time to filter those moments. So let's go for the rules of this strategy. But yeah, if you are on the market sometime, I probably, you know, how it's gonna be played out. So basically, if we have, for example, firstly, let's check good examples, only the profitable ones, so you will see the point. Okay, maybe let's start from here. If we have the moment when the price is going beyond the Bollinger Band and the RSI is going below the 30 level, we are entering the buy trade. When the price goes inside the channel, the Bollinger Bands channel, and our take profit level is the opposite boundary. So if we have this example, let's say we could enter inside the Bollinger Band. It is not you don't need to fear as for the, you know, bad trades, because the risk reward ratio here is very good. So for example, for potential, let's say we have 6 pips, you can obtain 16. So this is more or less 3-to-1 ratio, and those kind of risk reward ratios are all over the place with this strategy. They are bouncing more or less in those levels. So even with the low win rate ratio, you will be able to get profit either way. And as for the explanation, why is that? Why is that the math is on our side in such scenarios with such risk reward ratio? You could check my other video where I am explaining this concept from the beginning with the calculations and with the examples. So this is an example of a buy trade. Let's check for a sell trade, which is right over here, right? So we have the opposite situation. When the price reached broke the upper boundary, went back, and the RSI was almost at the 70 level. You can see it's 60, wait a second, it's 67, 60.65, so it is almost 70 level, and those kind of trades I'm also taking into account. And what we are doing, we are entering when the price is going back to the channel, inside the channel, and we are exiting when the price goes inside, when the price reaches the opposite boundary. So yeah, it would depend if we would close over here or somewhere over here, but let's say it would be just 20 pips. So we have maybe add pips because it is always spread, and we have 5 pips stop loss, and for example in this situation we could obtain 20 pips profit. So now if you would go down this way, you could also see that there were also bad trades, right? So as you can see also over here, we would have entry, the price went down, the RSI is below 30, we closed inside and opened inside, another candle opened inside the channel, so more or less we could enter here, stop loss below the nearest lowest point, which as you can see again it gives us 5-6 pips. And yeah, if we could have some good reflex, we could take those 15 pips. right? Or we could wait for the we could wait. We could set the stop loss at break even and wait for the scenario to to be fulfilled. But so we could at least have the break even at this trade. So let's check down the line again. Other examples you can see for here we would be stopped out once, maybe twice, right? The price went above the Bollinger Bands and we closed here inside the channel, open here inside the channel, so this would be more or less our entry level, and here we would be stopped out at this candle. So as you can see, you could use additional filter when the price is starting to range, when the higher volatility period on the market begins. Therefore, you could be wary of such situations when the stop loss, for example, is too wide. As you can see, 3 times wider than the previous examples. So let's go further, let's go back and check those examples when we have the ranging market. Again, you see right here, the price went below the Bollinger Bands. It almost touched the 30 level. It is 31.31. The price went inside the channel, so we could enter here. The lowest point is here at this level. So maybe let's zoom it in. You see, here is the lowest point, so we are adding at least 1 pip or 2 for the spread, and we have exit at the opposite boundary, so it is 9 pips. Okay, so this one is 2 to 1. But for example, here again we have situation for a long position. We went beyond the Bollinger Band, doji candle, we opened inside the channel, so more or less we could enter here. The lowest point is over here, so we are, where is this? So we are 3.9, 4.9, okay, 1.5 pips for this, for the 1.5 pips to the stop loss level, and somewhere over here we exit, we take profit. We have taken profit. That sounds better with this green candle when it crossed, touched and crossed the Bollinger Band and giving us 17 pips profit. So again, it is 3 to 1 risk reward ratio, and we could go further with the examples, but I hope you get what I have on me, how this strategy works. So yeah, I hope you enjoyed this video. If yes, then just subscribe for more, and yeah, see you in the next one. Take care, bye.